Very good morning everyone. Welcome back in this series of finance and editorial analysis. In today's analysis we have 3 articles broadly, okay? So out of all those newspapers, ET, Mint, Business Line, Business Standard, Hindu, Indian Express, I have selected 3 articles which were related to finance and economy and relevant for you as well, right? I am clearly audible and visible to you, okay? Yes or no? Very good morning. Audio video is clear? All right, good. So let's start, and in today's series we have 3 interesting editorials. They are very interesting and relatable to your syllabus of these examinations as well, right? So the first article which you can see here is "Don't add to the burden of regulation on banks." So this has been selected from the Mint. You can go to the newspapers and read these articles so that you get to know what has been explained, okay? That's why I have included the entire screenshot so that you can easily find out the article, okay? So this is taken from the Mint. Now, what is this editorial talking about? So here you can see the image of RBI, right? So basically it is talking about some RBI's decision, or RBI has, shown some interest in reviewing the liquidity coverage ratio. So it has talked about this entire thing in the editorial, right? So this is your article, "Don't add to the burden of regulation on banks." So the main theme of the article is that already banking system in India, or the commercial banks, have a lot to comply with. They have a lot of regulations, norms which they need to comply with, right? If they need to work as a bank and if they don't want their license to get cancelled by RBI, right? So what is this that is adding to that burden? This has been talked about, right? So we'll come to this point later. So what did RBI governor say? What did RBI governor say? Just wait. Right. So what did RBI governor say? What is in the news? So while presenting the first monetary policy statement, for the fiscal year 24-25 in April, PDF आप लोगों को मिल रहा होगा इसका, ओके? हर एडिटोरियल का आपको PDF मिल रहा है, आई थिंक इन द टेलीग्राम चैनल, और आई विल कंफर्म इट टू यू, ओके? सो द न्यूज इज दैट in the financial year of 2024-25, you know what a financial and fiscal year is, right? During which period the major accounting is done in the economy. Accounting and finance related calculations are done, right? So while presenting the first monetary policy statement for fiscal year 2024 in April, RBI Governor Shaktikant Das had announced that RBI would review its liquidity coverage ratio framework to ensure smooth functioning of the system even in the event of acute stress. So this is mainly the news which the editorial is surrounding, okay? So the editorial talks about this news. So RBI Governor Shaktikant Das has announced in the monetary policy statement recently in April that the liquidity coverage ratio is to be reviewed. Okay, now there are certain things you need to understand regarding this. First you understand the concept, then you will be able to relate all of them, right? Just stay tuned, it is going to be very interesting session for today, okay? So first let's try to understand what is a monetary policy statement. When I say monetary policy statement, it means it is basically a statement released by RBI, very important statement or document released every year by the Reserve Bank of India biannually. Biannually means 2 times in a year, so after a 6 months period, right? So it is released biannually, okay? What is it about? It tells how the RBI is perceiving the macroeconomic conditions in the economy. What is the RBI looking forward to? What are their policy decisions to be taken in future, right? So all these things, RBI's point of view on the present economic or macroeconomic situations basically. Is that clear? It is presented biannually, okay, 2 times in a year. So this monetary policy statement is in the news because the RBI governor has said that the liquidity coverage ratio LCR is to be reviewed. Okay, now to understand this news, MPC is bi-monthly, but it is not MPC, okay. This is monetary policy statement. Vijay, monetary policy statement is different from monetary policy committee, okay. This is a report. MPC is a committee which oversees all the monetary policies decisions of the RBI, okay. So MPC is basically monetary policy committee. It takes all the decisions regarding changing the key policy rates, CRR, SLR, repo rates and all these key policy rates. So this is a committee. The meeting of this committee happens bi-monthly. I am not talking about MPC. We are talking about monetary policy statement, which is a report published by RBI biannually. Okay. All right. Now to understand this news, you need to first understand what is liquidity coverage ratio then, right? Then only we can proceed further. So let's see what is liquidity coverage ratio. LCR, liquidity coverage ratio. So liquidity coverage ratio, as the name suggests, you must be getting some hint out of the name that it is a ratio which is showing how much liquidity does someone has, right? Liquidity coverage. So basically it indicates the proportion of highly liquid assets held by the banks. Proportion of highly liquid assets held by the banks to ensure their ability to meet short-term obligations. Short-term means it is around for 30 calendar days, okay. So what is LCR? It is basically the proportion of highly liquid assets. What are liquid assets? Yes, 30 calendar days. Liquidity. What is liquidity? What do you understand by liquidity? When we say that certain asset is liquid, it means that it can be easily converted to cash, okay. It might not be cash or something which is directly used in the transaction process, but it can be easily convertible into cash, or it can be easily used in transaction process. Yes, very good, right? So this is liquidity. So liquidity coverage ratio tells us how many such assets are there with the banks which are highly liquid. Highly liquid means that in case of an emergency or to meet their short-term day-to-day requirements, they can use them or easily convert them into cash. This is a very important indicator. Remember, very important topic for you as well in your examinations. You cannot afford to not know about this topic, right? Not knowing about this topic might cause you a huge cost, okay. So LCR is this. Now what is the formula? What is the formula of calculating LCR? It is calculated by dividing a bank's high quality liquidity asset by total net cash flows. So basically dividing high quality liquidity assets through total by total net cash flows into 100. So this is your formula for liquidity coverage ratio. You can write it down. You can write this formula for liquidity coverage ratio. Just write it down. Liquidity coverage ratio is when you divide the high quality liquidity assets which are owned by the commercial banks by their net cash flows. I will explain the components to you, multiplied by 100 to get the percentage, okay. Have you written this formula? You can take a screenshot as well, okay. Alright, so moving ahead. Now, let me explain what do we mean when we say that we divide high quality liquidity assets. So liquidity assets you all know by now, right? Those assets which are very liquid, easily convertible into cash. Dividing it by total net cash flows. Net of anything means outflow, or in this case outflow minus inflow. Net means what is coming to you and what is going from you. Difference between that. Okay. So net. When we take net of cash flows. So as you know that banks are involved actively in transactions. There are certain cash flows which are coming towards the bank, which the bank is receiving. Okay, which the bank is receiving, and there are certain flows which the bank is paying. Okay, can you give an example? HQLA, you give me the example of high quality liquid assets, any one of you, I would appreciate that. Otherwise I'll give you the example, right? So okay, net cash flows. Did you get it? What is net cash flow? Net cash flow means dividing total cash flow or outflow, total outflow, which means all the transactions done by the bank to someone else minus total inflow. All the cash flows which the bank received. So net of outflows, total outflows and total inflows. Right? Is that clear? Are you clear with this concept? LCR? Everyone? Just let me know so that I can proceed. Okay. I will take up this question of you, high quality liquid assets, and someone is saying that HQLA means cash central bank reserves. No. Don't get confused with these things. Central bank reserves like CRR, SLR do not provide you interest. They cannot be used for credit creation or any other purpose. So I'll come to it later, right? Gold, certificate of deposits, yes. So there are certain instruments which can be easily convertible. Your money market instruments they are, right? Cash, gold, securities, some commercial papers, right? Okay, all right. So let's come back to the topic. Is it clear now? So this is your LCR. Now LCR reflects how much liquidity does a bank has. Higher the liquidity, lesser is the risk of any stress on the bank. So even if there is a crisis or any stress, the bank will be able to manage the liquidity. Is that clear? So this is why this is important. Any bank needs to have a good amount of liquidity to stand by any crisis or stress, right? And you all know that nowadays we are facing very uncertainties regarding the finance or economy, right? So this is your LCR. Now coming back to the news. Now you would relate to it that the governor is saying that they want to review the LCR. They want to review the liquidity coverage ratio. Why do they want to review this is now the news for us, right? So he has said that recent events in other countries, have shown that digital channels have been used by customers to quickly withdraw or transfer funds from banks. So basic thing which has been highlighted, let me read this point as well. Today technology has enabled instantaneous transfers, with the result that banks are faced with a stiff challenge in managing their liquidity position to make sure they have sufficient cash at all the times. What are these 2 points saying to us? Say, it is nothing but that the governor is saying that examples from all over the world are highlighting that due to digitalization, as you all know, now your transactions are just at your fingertips, okay? You just have to click and then the transaction happens. So it doesn't take time, and therefore people are able to do instantaneous transactions, more number of transactions, so more withdrawals have become easier and prevalent from the banks. Are you getting my point? Okay, so more withdrawals, more frequent withdrawals. What happens is then the liquidity of the banks get affected, right? So suppose there are a lot of people doing so many withdrawals from a bank, the bank will have to manage the liquidity or the cash available with them. Because how does a bank create credit? Banks create credit through the deposits of their depositors. The money which we deposit into the bank gets created as loan, right? So it is affecting these instantaneous transfers, digital transfers, which we all do nowadays, are affecting banking system's liquidity in India. Are you getting my point? So it is not a major concern now, but it can be a threat in future. So better to prevent it than curing it, right? So prevention is always better than cure. That is the concern. Are you getting my point? What is in the news? Right? So let's see further. So we have seen LCR. Then one more thing highlighted by the author is, so this was said by RBI that due to digitalization and instant transactions, we need to review the liquidity regulations of banking. Otherwise, in future it can pose a serious threat, and there can be a situation called as run on bank. Do you know what is run on bank? Anyone? Something called as run on bank. Run on bank. What is run on bank? What is run on bank? Run on bank is situation when all the depositors, say in a bank, are going same day, same time to withdraw their money, right? So just try to understand this, that banks work on an assumption. What is the assumption? Suppose you are a bank and there are a lot of depositors who have deposited their money into your bank, okay? You assume that when you extend credit or loan out of those deposits, everyone is not going to come at the same time to withdraw the money. So banks work on this assumption, but it might happen sometimes that, which happened in the crisis which we have had in history. So like in the Great Depression, right? So when all the people, all the depositors of the bank, when they lose trust in a bank, they sometimes rush at the same time to withdraw their money, and bank does not have the money. This is the reality, because your money has been given as loan to you, to someone else. Are you getting my point? Yes. So to avoid such situations, we need to work upon this. This is the editorial talking about. Now, the author has highlighted that under the Banking Regulation Act of 1949, very important act, okay, Banking Regulation Act of 1949, banking business is a business of taking deposits repayable on demand, right? So author highlights that this Act, Banking Regulation Act of 1949, defines banking. How does it define banking? It defines banking as a business which is related to taking deposits. Okay, it is a business of taking deposits. But taking deposits is not enough here. These deposits are to be repayable on demand. This is something very important. You should remember. You can note it down. You can write it into your answers. Okay, so repayable on demand. Repayable on demand. This is important. Repayable on demand. So when you have deposits, they should be repayable. If people are there, you should honor their demand and pay back them. So run on bank situation should not arise in your banking system. Hence, banks must always be able to honor any and all demands from customers for repayment. Any and all demands. Whosoever is coming to your bank, who is your customer, to demanding their deposit, you should honor their demand and should pay back to them. Are you getting my point? Right? So this is highlighted. Then Governor, RBI Governor has also said that it is during acute stress, when there is a lot of stress on liquidity in the banking system, okay, or there is some kind of crisis going on in an economy, that a framework like LCR, liquidity coverage ratio, a prudential tool to check a bank's ability to meet cash outflows in the near future, is most needed. So this is in such times like run on bank, like any other crisis, that you need to have a prudential set of norms related to something called liquidity coverage ratio. Right? So you need to review these things Review so as to increase the liquidity in the banking system. So RBI is planning to review LCR so that it does not harm the customer or the depositor as well, nor the creditors, neither the creditors nor the borrowers as well. Okay. So RBI says this, right? But the author has a very different opinion and a solution to this problem. What is this solution? Yes, you have to repay, right? What is the solution which the editorial is talking about? Very interesting. Just listen very carefully. That author says, instead of increasing the compliance burden on the banks, as was the heading of the editorial. So instead of increasing the compliance burden on the banks, which already have a lot to do, can we just find a way of tweaking the rules that govern online transfers? So author is basically highlighting that if we try, as the RBI governor has declared that they'll try to review the LCR, if they make it more stringent, more strict, and the banks are required to follow the norms more strictly, that would be a burden on banking system in India, which is already having a lot of compliance norms. Are you getting my point? So why to increase the burden on the bank? In order to help the bank only. Can't we have any other solution? We can have. Like, can we tweak some regulations or rules which are there for such online transactions only and do not disturb the banking system? Limiting RTGS, yes. Okay. So can we do this? Govern online transactions? Yes. So the author has given suggestions regarding this. What are these suggestions? Like the author has said that we can limit the RTGS transfers, for example, okay, which are high value and usually business related. So that so he is suggesting that we can limit transactions to a time period, like in the office hours, which is to say from 8 AM to 6 PM. Only between that period of time you can do the transactions, so that apart from that time bank does not get so much of transactions and liquidity to certain extent is saved with the bank. Are you getting my point? Now, why author has targeted RTGS only? Why not the retail transactions? Why only RTGS, NEFT and these kind of transactions? Because what is RTGS first? To all of them who don't know RTGS, first tell me, do you know what is RTGS? Let me know what is RTGS. RTGS. What is RTGS? No, you don't know, right? So let me explain it to you, then I'll move further. RTGS is basically real time gross settlement. Real time gross settlement. Now this is the definition or full form, right? RTGS. But what it is? Yes, real time gross settlement. What is it? So basically, you have several methods or mechanisms of transferring from one bank to the other or doing the transactions, online transactions, okay? Online, offline, for example, particularly related to business. When you have a business, you have to transfer certain big amounts as well, and that too need to be very secured or highly secured. So RTGS is basically a transfer mechanism or you can consider it as a payment method, okay? Payment method which is able to do high value transactions, big amount transactions of businesses, right? Also in real time, as the name suggests. Real time means instantly. For example, NEFT takes time, but in comparison to NEFT, RTGS is very quick, okay? And there is no maximum limit as well. Alright, so it helps in high value business transactions which are secured as well. So it is a secured transaction. It's not like sending money through UPI payment. For example, you have to send 2 lakh to someone. It would not be secure to send it through your UPI ID or UPI payment method, but it will be secure to send it through the RTGS method. Now is it clear to you all what is RTGS? Right? Real time gross settlement. I hope you understood what is RTGS. Let's move ahead. So here the author is saying, okay, UPI is unsecured. I am not saying UPI is always unsecured. That is a debate, okay. I would not want to get indulged in this debate because there are security leaks. As you all know, nowadays transactions are very easy to be hacked, right? So it is a debate. You can have your opinion, I can have my opinion. Let's do not get into it. We have to cover 3 editorials today, okay. So why author is trying to limit the RTGS transfers? Is saying that we can limit this because these are first of all business related. They are huge amounts. So if you limit something which is huge in amount, it would leave huge amount of liquidity with the banks. So when RTGS is not done, say for example before 8 am and after 6 pm, that would leave a huge amount as liquidity with the bank. So it would impact the liquidity status substantially. So you should not target tweaking the rules for such transactions which are lesser in amount. Right? So this is the logic. Another thing, that since business transactions are planned, moreover these kind of transactions are planned transactions, so you can control them. You can have certain regulations or rules or set of norms for them. You cannot have a limitation of transaction for such transactions which are not planned. For example, in the stock market, share market, the retail investments or the retail transactions which you have of the financial market, right? They are very uncertain. Moreover, they are very smaller in number and they have to be settled during their opening hours only. So when a stock market opens and ends, you have to do the transaction in between. You cannot tweak the transaction hours for such retail transactions or payments. Are you getting my point? So that is very interesting point highlighted by the author, that since business transactions are planned and are big in amount, they can be rescheduled. You can reschedule their timing. But retail transactions, what are retail transactions? Like your transactions in stock market, share market, cannot be. Why? Because they have to be done in their opening hours. You have to do the transaction when the stock market opens up. So you cannot reschedule the timing of such transactions, right? Isn't it interesting? Very different opinion presented by the author to a very common problem in Indian banking system. Isn't it? Agree or not, right? Such reforms can be done without impairing business efficiency and adding to the liquidity of banks. So now the author says that you can adopt such kind of policies as well. Here you are neither impairing the business activities, you are not affecting the business because you are limiting that transaction time to business hour only. Right? Also, you are adding to the liquidity of your banking system, which is a concern for the central bank or the banking sector regulator. So this is the entire story highlighted in this editorial. Very interesting and very useful for you. Okay, right? So let's come back to the title. So this was your title. Don't add to the burden of regulation on banks. That's what the author tried to say, that don't add in the compliance burden of the banks. Instead, find out some other ways so that the business do not get affected as well as the bank also gets enough liquidity. Now let me know, you are clear with this editorial? Interesting, right? Shall I move ahead with the second one? Yes, author is trying to debate with the RBI, and that would be a negative connotation to say that the author is trying to debate with the RBI. Rather, you can say that the author is trying to suggest alternative to the RBI. Okay, and remember one thing as well, my genuine suggestion to you all, that whichever exam you are preparing for, UPSC, RBI, SEBI, NABARD, okay, any exam, when you sit in the interview, for the interview before the panel, you have to be positive in your approach. Your statements should not reflect your political inclinations, your regional inclinations, your regional identities, alright, be it any examination, because you are going into the system. You cannot criticize the system which you are aspiring to be part of. Are you getting my point? So use such words and statements in positive sense, or which are reflecting some positive connotation. Okay, right? So let's move ahead. This was our first editorial. Second one is also interesting. All right. So another one is, this has been taken from the business standard. As you can see here, business standard, it is titled as demand revival. Okay, titled as demand revival. So there is not so much as news in this editorial, but I picked it up for your understanding of how these macroeconomic variables work, which is very important for you regarding your economic syllabus as well, right? So business standard, demand revival. Okay, this is your editorial, second editorial. What is this article saying? So in this, the author first has highlighted that, you know, companies' growth, net sales, all these things have been picking up in India. Okay, so company results of quarter 4, this data is not important for us, we are just trying to link it with some concepts, therefore. Okay, so company results of quarter 4 of financial year 2024, you all know what is a quarter, right? You all know what is a quarter, right? Of 3 months, 4 months, let me know quickly. How many quarters do we have in a financial year? 3 quarters or 4 quarters? So quarter is basically, we divide the financial year, okay, for easing the calculation years, 4 quarters, and 1 quarter has 3 months into it, right? Yes, period of 3 months. Okay, so the 4th quarter of financial year 24 was from Jan to March. So this data of this quarter shows that some companies, corporations in India, they indicate that corporate growth has improved. In India, corporate growth has improved. Their profits, their sales is improving. Okay, and demand in many sectors is reviving in India. This is important for us. In India, many sectors aggregate demand is reviving. Okay, now I'll explain it to you. What is the issue? Why are we focusing on increase in demand? And what has been the previous trend? The author says that for several quarters before this period, or before this last financial year, for several quarters, economy was driven by government spending with low consumption expenditure, but now the situation is changing. So here the focus is on some static concepts which you need to be very clear about. It improves your economic analysis. Let me explain it to you. How? So first you need to understand that why do we need demand of something in the economy, okay? It's only then we have aggregate demand, either demand or aggregate demand. When I say aggregate demand, I mean that demand in the country as a whole or economy as a whole. So say aggregate demand, ED, aggregate demand, okay? Whichever sector it is or whichever economy it is, aggregate demand is the driver of economic growth. Remember this, driver of economic growth. Why do I say that? If you don't have demand, your economy might get into recession and further into depression like situation. How severe it can be, you don't realize. Okay, why? See, say if demand, overall demand in the economy, consumption goods, capital goods, any sector, agriculture, industry, manufacturing, food processing, anything, if demand is less, suppose, okay, index of industrial production, yes, we can release this news to recent update. Yes. IIP is an important index which you have of 8 core industries of India. Okay, so homework for you today is find out the name of 8 core industries which are there in the IIP. Okay, very important question. More demand, more production, high employment. Very good, very good. You have a good command over these concepts. So homework for all of you today. What all core industries are there of which there is a weightage given to the IIP, Index of Industrial Production. Okay, find out the names and let me know in the tomorrow's session, okay, or next class. So when aggregate demand falls, what happens is, if you don't have demand for a product, the supplier or producer would not have any incentive to produce that, because if demand is falling, price will be falling, and price and profit is the only incentive for the producers, right? So if demand falls, the supply gets cut or it gets reduced by the supplier, Why? They don't have incentive. If they keep on producing more supply and less demand will increase the downward trend in the price. So prices will fall again. It would harm the supplier. It would lead to huge losses to the supplier or the producer, right? So they try to cut on the production when demand is low. When production is cut down, what happens is you fire out some of your employees. You fire out some of the employees who are no longer needed, right? So it leads to unemployment. Unemployment. Yes or no? When unemployment is there, you are not earning properly. So earnings decline, isn't it? When earnings fall, your standard of living falls. So per capita income declines. Per capita means per person. Per capita income declines. Per capita income declines. When per capita income declines, it means that people in your country, how do we get per capita income? Dividing the national income by the total population, okay? So you get to know how much each person is earning, right? So per capita income declines, which again means your purchasing power is less. If you don't have income, how would you purchase? Yes or no? So your purchasing power is less. When your purchasing power is less, you will demand less again. Yes or no? So it would again create this loop. And when your income is less, it means national income is also less. GDP is also less. Purchasing power declines, again less aggregate demand. Less aggregate demand means again lesser economic activities, and this vicious cycle keeps on going over there. Yes, vicious cycle. Are you getting this point? So it continues and it finally affects the economic growth of your nation. That's why you need to have demand. Okay. I think it would be clear. So my intention of explaining everything through this chain reaction or step by step to you is that you get very handy about these concepts and you get to know how can you explain things in economics in your answers, descriptive answers, right? So you can use such chain reactions that this happens, then this happens, it happens, then next is this, right? So it improves your marks relatively. How? First, the examiner gets a hint that you are very clear about the concept. That's why you are not writing in the paragraphs. क्योंकि पैराग्राफ्स में हम कई बार रामायण भी लिख देते हैं, राइट? इफ यू डोंट नो अबाउट द कंसेप्ट, सो इट शोज योर कॉन्फिडेंस इनटू द कंसेप्ट एंड मोर improved presentation of the answer. It would make your answer stand out from the others. You will fetch 1 or 2 more marks. Is that clear? So you can use this way. So that's how I tried to explain the importance of demand in an economy to you, right? Now let's come back. So the concern is that, you know, after corona or since corona time, we have been witnessing lesser aggregate demand in the economy. So lesser aggregate demand, why? People were not earning. Unemployment rose. Many of them were fired out. Some of the employees of private companies fired out, right? So in that case, the author says that for several quarters, Indian economy was driven by government spending or low consumption expenditure. These two terms, very important. Government spending and low consumption expenditure. So author says that government spending is the driver of economic growth since last many quarters, and we have a very low consumption expenditure, but this is not good for your economy. Why it is not good for your economy? I'll explain. See, remember one equation, okay, that y is equals to c plus I plus g plus x minus m, which says that y here is your national income, okay. Whenever I write capital Y, it means income. So national income is a function of, or say it depends on, your consumption expenditure in the economy. C stands for consumption expenditure. I, you can write it down, C for consumption expenditure, I stands for investment expenditure, G stands for government expenditure, and X minus M means net exports, okay. Net exports means exports of your country minus imports. So net of your transactions as exports and imports. Exports minus imports is net exports, right? Now why I have written this equation for you, because now you can see that there is a direct connection. If your consumption expenditure increases, your national income increases. If your investment increases, national income increases. Government expenditure increases, national income increases. So there is more growth. Yes, but what is the problem which Indian economy is facing? Low consumption expenditure and high government expenditure. What is consumption expenditure? Expenditure on consumption, not investment, right? Which you consume for yourself, not for any economic activity. Okay. G, expenditure done by the government. You need to increase this. Why? Because if you don't increase this, you will have a lower aggregate demand. In that case, government has to step in. Government will increase its government expenditure to maintain the crisis, but it has certain limitations. There is something called fiscal deficit, which I have explained to you in earlier editorial analysis, right? You can refer to earlier videos for explanation of FD, fiscal deficit, and I have explained why fiscal deficit for any economy, rising fiscal deficit is a concern. How does it harm the economy, right? So increasing government expenditure increases burden on the government, because government already has a lot to spend upon. Okay, the government has to take care of the entire nation. If you increase the burden, the fiscal deficit will increase, and that would cause harm to you only, right? And we have already discussed in detail that how fiscal deficit increases the harm to the economy. So that's why you need to correct this. You need to have more consumption expenditure. How do you have more consumption expenditure? Only when you have demand. When will you have demand? When you have purchasing power. Simple. When will you have purchasing power? When you are earning good. Again, it means employment and more development opportunities, more economic activities in the economy, right? So let's get back again to the editorial. Here you can see that government spending is driven, this growth is government spending driven, and there is low consumption expenditure. But now the author is saying that this situation is changing. Like there are certain sectors like the automobile sector. Automobile sector has been witnessing a substantial increase in the demand, okay? But there are still certain goods which are very important in increasing the economic growth and affecting the aggregate demand, which are in daily use, called the fast moving consumer goods. What are FMCGs? Fast moving consumer goods are those goods which are non-durable. So the demand for such goods moves very fast or changes very fast. Yes, crowding out effect. Very good, Ankita. You remember fiscal deficit causes crowding out. Very good. Okay. So FMCG, what is fast moving consumer good? Which is non-durable, which for the demand for which changes and expenditure on which goods change very frequently. For example, milk, curd, paneer, vegetables, fruits, bread. So our day-to-day requirements, they can affect the consumption expenditure to a huge extent. But again, it is not very impressive. It is not working very impressively. But the automobile sector is, right? Then we have certain other sectors like IT and pharma. IT and pharma, the information technology sector and the pharmaceutical sector. So IT industry is also performing good, but relatively pharmaceutical sector has been performing good. So there is a growth in pharmaceutical sector. So this is highlighted. So the author is trying to say that such disruptions are getting cleared out and the growth in Indian economy is reviving, or the supply chain disruptions which we have due to COVID-19 are easing and supply is gradually reviving. We have had supply chain disruptions due to COVID, right? Factories were shut down, industries were shut down, there was a lack of supply. So there is one important thing which you should note down is that the inflation caused during and after COVID-19 was less of demand pull and more of cost push, or say supply side inflation. So the inflation which you witnessed immediately after the COVID-19 was a result of supply side inflation. When I say supply side inflation, it means that it was not because of rising demand, it was because of less supply, because we had supply side disruptions due to dysfunctioning of the economic activities in all of the major economies of the world. Are you getting my point? And there is one more word which I told you in one of the classes, that an interesting word, fancy word which can be asked for supply chain disruptions or supply side inflation. It is known as, can anyone tell me what is it called? When the inflation is supply side, what do we call it? We call it bottleneck inflation. You can write it down, bottleneck inflation. Bottleneck inflation. Okay, so supply side inflations are known as bottleneck inflation. So this situation has been reviving, and particularly government's focus on infrastructure development is creating the difference, because for infrastructure you need lot of employment as well. So people are getting employed. Again, infrastructure development is a capital expenditure. What kind of expenditure it is? Capital expenditure in the budget. That means some kind of expenditure which is increasing your asset or adding to your assets. So when infrastructure gets developed, it adds to your assets, right? And mainly it has resulted in rise in aggregate demand. As you all know now that aggregate demand, who is the driver of economic growth? So if I ask you that, tell me in one word, not even in one word, only in 2 letters, who is the driver of economic growth? It would be AD, aggregate demand. No, it is not demand pull inflation, it is supply side inflation. Okay, bottleneck. Yeah, but the answer should not be demand pull inflation, it should be aggregate demand. Okay, aggregate demand. So in near future, AD may revive further, leading to more GDP for India. This was the article all about. Interesting, right? It takes a lot of energy to explain all these things, but still it would be worth it if you get anything useful out of it. Okay, so this was your second editorial. It covered your static part as well, and you get to know the trend which is there in the Indian economy, right? Now moving on to the third and the last one for today. Okay, so this third one has also been taken from the Mint. Okay, so you can refer to the editorial section of Mint. There you will be able to find this article. Okay, Mint. So it talks about basically about rising private credit in India and evergreening of loans, or the editorial's title is Finance in India has a new bogey called private credit. So this editorial has mainly, yes, Ankita, thank you. Okay, so main concern or main theme of this editorial is private credit. The author is saying that in India you have a new bogey, like in the train you have new coaches, right, which is private credit, which is emerging very fast, and it is, if it gets unchecked and unregulated, it can pose a threat to Indian economy. How and what is the concern? Let's see. Okay, so this is your editorial from Mint. You can read this article. Now, so before understanding the concerns about this rising private credit situation in India, first you need to know about what is a private credit, right? So credit, you all know, is a loan. What is private credit? Private credit, or also known as private debt, is basically a loan or bonds provided by a non-bank investor. So as the name suggests, private, which means it is not public. So it does not fall extensively under the regulations set up by the government or by the banking regulator. Are you getting my point? Direct lending, yes, or lending by the private funds. There are a lot of funds which have been established, private companies or funds which indulge in this lending activity, right? For example, you have something related to Piramal Group, the Kotak and the KKK, something like this. Okay, so they are private funds which are indulging in these kind of lending activities. So this is your private credit. Now there is an important term called institutional credit, and then you have non-institutional credit. When I say institutional credit, so the credit which has been taken from institutional mechanism. What is the institutional mechanism? Which is the institute which is responsible for granting credit in India? Answers please, quickly. What is institutional credit? Or when I say institutional credit, what arrives in your mind? What strikes to your mind? Banks. Very good. banks. So credit should be institutional as much as it can be in any economy, so that it does not harm, rather it gives the benefit out of that process, right? Banks. But there are other mechanisms. So in the previous times when you didn't have the banking system established properly, there were the zamindars. So you must have seen in the Bollywood movies, the Sahukar, golden chashma. Okay, my chashma is black, so I am not a Sahukar for that matter. Golden chashma, right? And always keeping a bag like this. And so they were the non-institutional lenders. But now you have other forms of non-institutional lenders. They are the private funds. So credit extended by them is becoming a concern in India if it gets unregulated. This is the editorial talking about. Okay, let's move ahead. So private credit is loan provided by a non-bank investor, typically by a fund, by a private fund. Okay, what is a private fund? It is basically a pooled investment where you collect the funds and then you invest in groups, say like mutual funds, right? Mutual fund works on the philosophy of pooling your fund so that the risk get divided and the dividend or profit gets increased, right? So a private fund is a pooled investment vehicle that is not required to be registered or regulated as an investment company. Okay, so it is not required to be registered or regulated as investment company. So they are not regulated to a great extent. So here is the lack. When they are not regulated to a great extent, then comes some irregularities. Are you getting my point? So let's talk about the issue. What is the issue? Issue is that RBI has been very keen in watching all these things. It is there in the news with the RBI as well. And there were events when RBI was forced to step in last year only, that when it became clear that a significant portion of private credit, this private credit in India, a very significant portion out of it is lent by private equity funds, was used for evergreening of existing loans. So this is the issue, evergreening. That's why I changed the title, evergreening of existing loans to borrowers on verge of defaulting on an old loan. Verge of defaulting on an old loan. What is the issue? What is evergreening? What is evergreening? Let me know. Do you know what is evergreening of loans? So another important concept, evergreening of loans. Evergreening of loans, loan for loan, yes, very good. Basically, when you give loan to the customer for repaying the old loan, so the loan gets evergreen. In that case, often it happens that you need not pay the principal amount for the time duration, but you pay the new interest charged. Are you getting my point? So it is basically giving loan for repaying the earlier loan, right? Fresh loan on existing loan. Yes, very good. But this is very harmful. Outstanding loan, piling up of loan can lead to a crash in the banking system if it increases to a huge stage, or say to a huge extent, right? So RBI has witnessed that there are these private equity funds or private funds which have been lending to companies which are there in the default list. So they are helping them increase their default. So they are evergreening their loans, So this is the issue. The central bank also detected that banks and NBFCs were investing in these funds. Now the issue became more severe. Yes, issue became more severe when they found out that our banks and NBFCs, non-banking financial companies, are indulging or in investment, or they are investing in these funds. So basically what is happening, our banks and NBFCs are investing in these private funds. These private funds are lending to such defaulter companies. So what is happening? Whose money is getting at higher risk? Whose money is at higher risk in this case? Let me know. Not always they are registered as NBFC, okay? Not always. So we cannot generalize. They have different set of regulations for it. No, not R's loss. Yes. Okay, so you have gone so deeper. Very good. I appreciate that. Yes. After all, it's our loss because it is the loss of the bank, money of the bank and the NBFCs. And the money with the bank is our money. Right? Public. Very good. Very good. I am impressed. I was only thinking about bank and you answered it R's loss. That's quite appreciating, and it means you have the presence of mind, you are there in the class. Okay, very good. So this is how it poses a threat to the banking system and NBFCs. Their money is at risk, but why is it happening? Because it is benefiting every one of them, right? Benefiting every one of them. Now let's see further what is happening. So basically these inflows were then used for meeting older repayment obligations. This worked as a win-win situation for both the borrower and lender. How is it a win-win situation? See, the borrower, which are the defaulter companies, okay, defaulters, they avoid loans getting tagged as NPA. So in their balance sheet, it's not getting corrupted. Their image, their CIBIL score is not getting affected. Why? Because now their loan is not getting classified as NPA. So they are abstaining as well from the RBI's the norms related to NPA or NPA framework or the IBC, insolvency and banking proceedings, insolvency and bankruptcy code or proceedings. So they are able to trespass those things. Also, they are getting abstained from the prompt corrective actions taken by RBI, right, and being referred for bankruptcy proceedings. So they are able to avoid this. Then the lender, the NBFCs, banks, on the other hand, avoided having to recognize loan impairments because the company was a loan defaulter. The bank which granted the loan to that company does not have to recognize loan impairments. So it also saves the image of the bank as well. But actually it is not helping because the bank has to incur the loss at the end only. Now you are not able to, you are able to hide that you have a lot of NPA, but in future you won't be able to do that. Are you getting my point? Also, the credit fund who is taking this money from the NBFCs and the banks and extending to the defaulters is earning interest. So they are the mediator, they are earning interest. So as far as they think they are earning interest, this is beneficial for them. So this is how it is a win-win situation for all of them, but it is not a win-win situation for our economy. Are you getting my point? It is a difficult time. If it increases, it would be a difficult time for us. Okay, so this has been highlighted. Then the author says that Indian private credit revealed propensity for refinancing stressed asset is another red flag. In India, nowadays, there are such private credits which are used for refinancing the stressed asset. Stressed asset means NPA. So this is our concern that this is happening again in India. Okay, such private funds are extending loans to refinance the NPA. It would negate all the hard initiatives taken by RBI and the government. It would negate all their hard work, right? So in which one risky event can potentially send the entire credit market into disarray. It can collapse the entire banking system, right? Then there is the issue of uneven regulation. They are not regulated properly as well as compared to the bank. So when I say not proper regulation, I mean in comparison to bank and NBFCs. It is not that they are very free. No. Okay. Unlike regulated entities, which are your banks, NBFCs, private credit providers do not have to make minimum provisions that, you know, this is the minimum reserves which you should have, as in the case of bank CRR, SLR, right? So there is nothing which is preventing them to do such things while extending credit. Clearly, there is a need for regulatory intervention here. So the author says that you need to have an eye over this phenomena going on in the Indian economy or financial market as well. Okay, otherwise you might end having a huge crisis in the entire financial and banking system of India. Okay, so this was the article. Now, when I come back to the previous slide, Here you can see, that's why I made this title as Rising Private Credit in India and Evergreening of Loans. So author has linked private credit increasing in India and the risk of evergreening of loans increasing, and then the risk of NPAs increasing. Very interesting, right? So this was your third article for today. That was it. Okay. That was it for today. These were very interesting articles, and they compel you to brainstorm, to think widely how these things are working. So you need not just mug up the facts, you need to interconnect them, connect them, and then apply them in understanding what is happening in your economy and in the world economy as well. So I hope this session was very useful for you, and we are looking to many more sessions, right? So I'll see you in the next session. That is it for today. I wish you a good luck and a very good day. Thank you so much.